Good afternoon, ladies and gentlemen, and welcome to the TRANSENSE Technologies results presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via transense@walbrookpr.com. The company may not be in a position to answer all questions received during the presentation. However, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I would now like to hand you over to Executive Chairman Nigel Rogers, Chief Financial Officer Melvyn Siegel, and Business Development Director Ryan Moore.
Hello everybody, and thanks for your attendance, and thank you, Tom, for the introduction. I see instantly from the statistics that it's really well attended today, so thank you very much, everybody, very much for your attention. I'm looking forward to telling you the story of what's happened at TRANSENSE over the last few months and about the outlook. So we're going to put cameras off while we're presenting in a moment. I'm going to start the presentation just with a bit of a recap of our midterm plan and a high-level review of where we've progressed since that midterm plan was last discussed 6 months ago. I'll then hand over to Ryan. Ryan's going to take us through business development and other activities at both translogik and then in our surface acoustic wave business, TRANSENSE. Melvyn will then give us a financial summary of the first half results and cash generation, etc. And then I'm going to be talking a little bit about current trading since the end of the period and the outlook. We'll be very happy to take questions. We have had a few questions submitted in advance, which look interesting. So what we're going to try and do is get through the presentation in about probably 35-40 minutes and leave plenty of time for Q&A. So if I, first of all, start my section with an overview and a bit of a recap first of the midterm plan. So this was published in our final results in September of last year, and this set out in those 3 columns the historic objectives of the business since the sale of iTrack to Bridgestone in 2020. So that was the 20 to 23 plan. The midterm plan 23 to 28 is set out here, and then we've just given a taster of what we see the long term looking like beyond 2028. So first of all, for the Bridgestone royalty, this has been the main driver of our top line growth since 2020. And we'll look at the chart of royalty development on the next page, which I'll come back to shortly. Meanwhile, in the midterm plan for 2023 to 2028, we expect to see compound annual growth rate of the underlying installation base on which the royalty is based, so volume of 15% per annum growth. Most people who are familiar with the company will know that the unit rate of royalty reduces in June 2025, and that the absolute royalty level in 2026 we expect to revert back to the 23 level. Long term, we expect to see the growth rate in installations slowing, and the Bridgestone royalty expires in 2030. I'll talk a little bit more in detail about that soon. Meanwhile, in translogik, the business has grown from about 500,000 revenue to about 1 million, with a compound annual growth rate of 15% over the last 3 years. But we expect translogik to generate annual step changes in revenue. It will be the main driver of company top line growth in the 23 to 28 period. And we're also aiming to move that to a recurring revenue model, which again, Ryan will cover. And we see very strong ongoing growth potential beyond 28 for this business. The addressable market, in truth, every time we open a new channel, we find a new addressable market, and we are absolutely confident of some very significant market opportunities and long-term growth. Meanwhile, in TRANSENSE, over the last 3 years, that's largely been a technical and commercial evaluation process. It hasn't been generating a lot of revenue. However, we're now at the stage where it's beginning. There are some small ongoing revenues from motorsport activity, but we're now beginning to get some real traction with application development projects in a number of target market sectors. Again, will be covered in a good deal of detail later on. But it's our aim for the SAW business to be financially self-sufficient in the 23 to 28 period, whilst building a pipeline of long-term production activity to go beyond. and ultimately TRANSENSE will be the main driver of top-line growth for the business beyond 2028 and become the principal source of long-term strategic value. You can see in the bottom row there how that all fits together for the company as a whole. So how have we progressed since the first publication of that plan? In FY24 to date, firstly, the Bridgestone royalty has increased 27% over the same period last year, and the current year growth has met the midterm planned compound annual growth rate of 15%. I'll show you a chart in a moment. In TRANSLOGIK, the tyre monitoring business, revenue has been stable from the existing sales channels. It was at a record level last year, and we've met the same number in the first half of this year. But meanwhile, the main activity there has been investing in sales and marketing resource in order to open up new market channels and create strong growth, which will start to be visible probably in the second half, but certainly in FY25. Meanwhile, in TRANSENSE, the revenue has been slightly constrained in the first half of the year. It's still a small number from which we're growing, but market conditions have been pretty tough out there, and I'm sure many of the companies which you follow as investors will be talking about extended decision-making cycles and generally fairly tough market conditions. We're not immune from that, but it doesn't particularly concern us over the midterm either, but it has had some impact on revenue in the first half of this year. But meanwhile, some really exciting scale and depth change in the pipeline, especially in the aerospace sector, which we'll cover shortly. In terms of the overall financials, double-digit top-line growth, profits up by 146%, comfortably more than doubled. Profits benefited from a short-term compression in the operating expenditure in the first half of the year, whilst the business was transitioning. We had the benefit of some cost savings of costs which came out of the P&L last year. You'll remember there was an exceptional cost relating to some people who left the business, but we're set to increase OPEX in the second half of the year as we invest in revenue-generating engineering and sales and marketing resource. Overall, again, strong cash generation and balance sheet, which Melvin will cover. So that gives you some overall orientation. I'm just going to dip into iTrack first before I hand over to Ryan. So many of you, I think the majority of you, will be familiar with this chart, which shows the progression of the iTrack royalty since inception at the bottom left-hand corner in July 2020, when the annualized run rate of the royalty was approximately 600,000. That was the value that was on the installations which we handed over to Bridgestone on completion of the transaction. You can see that between then and December 23, the ongoing royalty rate has quadrupled. The installation base has risen fourfold to exceed 2.5 million currently at the January 2024 level there. So overall, the trajectory of that graph is looking very good and broadly speaking in line with the expectations that we set in the market in June of 2020. Slightly lower in 2023, it was a slightly flatter curve. And you can see right at the end of 2023, towards the top right-hand corner of that chart, some very strong growth in the transition from 2023 to 2024. So in the final calendar quarter of 2023, there was a very large number of new installations. Unfortunately, you'll see a small downturn in the graph in the period September, October, November 23. That was caused by a strike in one of the large mining clients of Bridgestone, which lasted for 3 months. It was a mine in Mexico called Penasquito, which because of the strike for that 3-month period, they actually decommissioned the use of the iTrack system while the trucks were not in use. And that resulted in a cost to us of probably about £60,000 of royalty. But you will see that downturn was corrected by the end of the calendar year 2023, and the mine was fully working by Christmas 2023 and is in the annualized run rate now. So overall, some very nice numbers coming out of iTrack. Very happy with that. That obviously provides a great deal of funding to the company, which is deployed in developing the SAW business and also is used to increase the cash balances of the business. I'll now pass over to you, Ryan, if you could take us through translogik.
Thanks, Nigel. So yeah, the translogik business is really seeing some very interesting developments and growth potential. It is a fairly simple product. It is a tool that is used to inspect and manage tires. A really critical thing about it is that it has to integrate with someone's enterprise management software. So we cannot sell the tool as a standalone product. It gets integrated into some kind of software environment, and that's either owned by our customers, or in fact it's us working with software providers. And there are, believe it or not, specialist software providers for tire companies, tire dealerships, commercial vehicle fleets, maintenance, etc., etc. So it's a big interesting world there. What the tool allows people to do is to gather and digitize tire inspection data, and that enables them to control the cost of their tires, which is the third biggest operating cost of their fleet. Also create a fantastic audit trail. So, if they ever have an issue from a compliance perspective, they can show that the tires have been inspected. And it allows them to identify issues with the tires in order to be able to extend the life of the tires. And that's something that you really can't do with conventional manual inspection tools, because they're just not accurate enough, and you can't gather the kind of data trail. So the tool itself, I think over this last year, we've been understanding how it's used in the market and what the potential is. And actually what we can see, because of that use case, is there's a very strong potential in the market for it, because customers want to know, want to be able to demonstrate compliance. They want to be able to manage their costs better, and also reduce emissions. And believe it or not, there is a very strong case around reducing tire consumption in a logistics fleet has a really big impact on their overall fleet emissions. So some really strong market drivers there for the product. At the moment, we mainly sell through very large commercial vehicle tire manufacturers, and it is of note that we've got and can count today 4 of the world's biggest 5 tire manufacturers as customers, in Bridgestone and Goodyear and Promethean, which is a name you might not recognize, but that's the commercial vehicle business of Pirelli and Continental. So that is an amazing platform for growth for this product, and also says there's something quite special about this product that we can build on here. So for us as a business, what we were trying to look at moving forwards was how can we take this product, take this platform that we've got, this customer base that we've got, and really build on it. This last year, we've done okay in terms of sales. We had a record year the prior year. The first half of this year has been in line with the previous year's record number, so we're okay with that. But what we can say is there's a huge potential to drive this forwards. So what have we done? Well, we came up with a plan to grow the business, and this involves putting some more boots on the ground, you might say, hiring some new people. So we brought in a dedicated sales director who's 100% focused on this business, and he has a huge wealth of experience from the commercial vehicle industry, previously from a telematics background, and very, very well connected in the commercial vehicle space. And we also have significantly a new marketing exec who is working 50% on translogik and 50% on the source side of the business. So if anyone follows us on social media, if you don't follow us, I'd recommend that you do. But you will notice that since January, there's been a big uptick in terms of our activity, and we have a really big plan in terms of marketing and comms for translogik as a dedicated business, getting it out to exhibitions and events, and putting the tool in front of people. What we're trying to do, not a surprise perhaps, but we want to build on our existing relationships. So we've got those 4 major global tire industry customers. They are very big businesses. They have operations across the world. And actually something of note that the company's talked about before is just a really simple, for example, we supply those companies in mainland Europe and in the US, but we don't even supply them in the UK. So there's an opportunity to expand the global reach with the existing customers, and working with their business divisions in North America, in South America, in Asia. And we see a tremendous potential there to expand with those existing tyre industry customers. But we're also looking really hard at how we can develop new opportunities and new routes to market. So, we've got 4 of the top 5 tyre manufacturers. There's another top 10, there's another 6 to go at. We want to try and build more customer relationships with more tyre manufacturers, and also retread specialist providers as well. We believe there's a significant opportunity to put these tools into tyre dealers and vehicle service centres, so they can be used as part of that sales process in a slightly different way. And we're building direct relationships there as well. One of the good ways that we can sell into a bigger number of customers than we might be able to reach directly is developing partnerships with reselling partners. And the company today already has some partners who are software developers, and we're looking actively for more software developers who are supplying tyre dealership management software or vehicle maintenance management software. So that's a very good channel for us. And then finally, direct fleet sales. So we can see up till now, most of the use of the tool has been for managing tyres by tyre suppliers, but a large proportion of the commercial vehicle market doesn't necessarily have managed tyre contracts. They manage their own tyres. So there's a big opportunity for direct sales to fleets, and that could be a commercial vehicle fleet, but it could also be a car rental fleet. For example, if you've ever picked up a hire car, you'll probably see on the vehicle condition report, for example, that there is a tyre inspection being carried out, because obviously you wouldn't want to take your hire car out with tyres that were not legal. So there's an awful lot of opportunities that we're working on here, and it's fair to say we've had some really good progress. So there's been a lot of preparation work gone into this over the last 3 months, and then our new sales directors hit the ground running in January. But already we've made good progress. We have direct contact now and opportunities running with 2 major UK tyre dealer groups, 5 new tyre and maintenance software providers, global businesses, 2 major UK commercial vehicle fleets. And also we've found and established connections with 2 new tyre manufacturers, so 2 global companies who are tyre manufacturers. And it's fair to say that we're getting a really positive response. The more hands that we put the tool in, people recognize the value that it can bring to their operations straight away. And we're really excited about the potential that we've got there for the future. So yeah, that's it in terms of translogik. Shall we move straight into the SAW part of the presentation?
Yes, please, Ryan. Yeah.
Okay. So following on from that, on the SAW side of the business, we've had some pretty significant hits. We're seeing continued growth overall in the pipeline, engagement with new key customers in our focus markets, and projects progressing through the pipeline, as well as progressing out of the pipeline if they're not opportunities that we think are able to progress for one reason or another. We are actively seeing our relationship with GE expand, increased activity on the 901 project, and developing new opportunities with them outside of 901. That includes long-term opportunities with GE, but also shorter-term, nearer-term opportunities to generate revenue through the provision of services and componentry to support their programs. We're continuing to cooperate with Parker and work alongside Parker, or though you'll have seen the note in the interim announcement about that. So very much still working with them, and we see them as a good partner for us and a route into the aerospace market, but nothing quite there yet. We do have some new contracted business for technical feasibility projects with a small aero engine manufacturer and a robotics drive system tier 1 supplier. So there's some small new business come through, and we've got continuing technical programs. One with an automotive tier 1 called Navares, and then 2 other programs which have been announced already, with an automotive tier 1 and aerospace tier 1, but we're confidential, where we can't disclose the names of those companies yet. So there's an awful lot of activity around SAW, and obviously some other notes in the interim announcement as well about what we're doing there. We do see that market pull really starting to crystallize for the business. I think the misses being, we are behind target in terms of the year-to-date revenue. As explained, that's really mainly down to a key motorsport championship where the technology has been used for a number of years. So that's been a repeating customer, but they've been upgrading their powertrain to a new type of powertrain, and unfortunately they've been delayed doing that, so that the order has slipped there for us. And then the other contracts and things that we're working on, with very large aerospace companies, defense companies. There are lengthy contracting processes, security clearance processes, etc. And I think we were hoping to be on contract with a couple of things by now that haven't quite got there yet, but we do expect to have some significant announcements coming in this respect. We've got a lot of planned activity for H2 of this year. We are really building some good steam in terms of the Marcoms that we're doing, obviously shared with the translogik side of the business. We're pushing more opportunities through the pipeline, so getting the contracted business with opportunities that we're talking to, and getting more things through to the quotation stage as well. So we're starting to see some really good momentum building there. And one of the big key things that will come in this next half is being able to do some specific work around the research that we've done on electric motors. And people remember we've invested in a program to investigate what benefits SAW technology can bring in electric motor drive systems. We've made some really interesting findings. We're in the process of applying for some patents and securing IP around that. And once that is done, we'll be able to start to talk in the market freely about that. And I, for one, it's my background, so I'm very excited about that as it starts to come through. So, looking at the key areas of the business, I think the motorsport market, as people know, we work with McLaren Applied in that space, and despite being behind because the championship has slipped in terms of its implementation of a new powertrain. It's fair to say McLaren are busier than they've ever been. I think our pipeline with McLaren is the largest it's ever been. A couple of years ago, the SAW technology was only really used in one motorsport championship. They now are engaged with, and we have supplied units to a number of teams in a number of different championships, and they are continuing to work on increasing that. It's a really big focus area for their business, and where they are trying to grow and extend their revenue and profitability in that side. So, we've got very interesting growing business in motorsport, and despite that short-term setback that we've had, we do expect motorsport to continue contributing and to grow overall in the business. The aerospace market is pretty interesting. So what we're trying to show on this slide is the progress that we have made and expect to make. So the table at the top here, looking at 2020, so looking back, we had one customer really in the aerospace market. As of last year, we'd extended that, so we had GE. We were dealing as well with Park and Meggitt, which was in the public domain, and we also disclosed that we'd acquired a new customer, so a different tier 1 from those two in the aerospace. Unfortunately, we can't share their name, and we had about 7 other opportunities that we were working on with aircraft or airframe componentry or engine suppliers in the industry. So then, looking at this year, very, very good progress again. working with GE still, and we have more work and more projects with GE. Continuing relationship with Park and Meggitt, still active program with the other aerospace tier 1, and that's a really significant and interesting project. And now 11 additional opportunities in the space where we're in discussion, active discussion about programs in a wide range of applications in the space, and we see that continuing. We're very, very close to being able to announce some things in the space. What the table on the bottom shows is what we now see as the key applications in aerospace for source sensing technology. So this has really evolved our thinking over the last sort of 12 to 18 months. The GE, the primary piece of business with GE is in the helicopter engine for measuring helicopter engine torque, and that's an application that we knew about, and it's partly driven by legislation and partly performance. But now, from the time that we spend in industry and working with different suppliers and different manufacturers, we see lots of other applications that are very well suited to saw torque. So engine torque in helicopters and turboprop type engines is key application area. The green ticks mean that we either have contracted business or we are in an advanced level of discussion with an aerospace tier 1 or OEM for that kind of application. So we've got contracted business, obviously, with GE that people know about. We are in discussion on the turboprop side at the moment, so we're looking at bringing that through. Another application is for helicopter, for tail rotor, measuring gearbox torque of the demand from the tail rotor. And again, that's a really interesting application on helicopters. We've also got flight surface, so flight control surface actuation torque, very interesting application on fixed wing aircraft, landing gear brake torque and landing gear brake temperature. So some really interesting applications there. Again, the green ticks. The other X's here are applications that we've identified, but we don't necessarily have an active discussion with someone in the space, but we are aiming to kind of fill out these boxes some more. So you'll start to see more contracted business fall into place in applications other than the helicopter engine torque application that people know about, and with a broader portfolio of customers, which I think is really important. And obviously, if you only have one customer, they catch a cold, so do we. But if we have a broader portfolio, that reduces business risk for us, and that's really what we're aiming for. So a broader portfolio of applications and of customers. I think we're making some really excellent progress on that front, and that will start to materialize into revenue, both sort of medium term from engineering support and program support revenue, and longer term from manufacturing revenue. In the electric drives space, we identified the opportunity for torque sensors to improve electric motor performance. And this, really because at the moment, you can't use conventional sensor technology for measuring torque and temperature in electric motors. And that's something we've talked about before, so I won't go into detail on that here. SAW technology allows us to be able to do that. So it kind of creates a new application. And in a way, this is different to in the aerospace industry where, engine torque in helicopters is measured today with conventional technology. So the SAW technology provides a kind of better mousetrap. It's a better way of doing something that they do with an existing technology. The difference in electric drives is it's not possible with current technology. So often the customer isn't even really thinking about using a sensor technology, because I'd love to be able to measure torque in my motor. I would love to be able to measure rotor temperature in my motor, but I can't because it's not possible with existing tech. So for us, really the thing that we have to do here is be able to talk more about the benefits that can bring, and then effectively educate the market in terms of, look, if you made the investment in putting SAW technology into your electric drive, this is what you would get back for that in terms of an improvement in performance or efficiency in that drive system. No one's going to invest in terms of putting that extra cost into their system unless they can see what the benefit is and if there's a sensible economic case there. So we've had this company, Drive System Design. They are renowned experts in actually transmission design and more recently in electric drive system design and development, a fantastic company. We've had them doing some simulation activity for us where they've been exploring these benefits and helping us build that case, and we've got some very good data already from that. They're now in the process of moving that to a physical test rig, so getting some actual test data that we'll be able to share with customers and put into the market. And we are working on these the patents that I mentioned earlier, so that's going very, very well. We're not aggressively pushing this into the market because we have to secure the patents. We have to kind of get the data to be able to support the business case. But in spite of that, we are on contract today with 2 tier 1 suppliers in the automotive space for source sensing opportunities, in electric drive systems. So, we do have some traction today already, and they are early stage projects, the things that we've been working with those customers for a while on. We also have 22 other active opportunities in e-drive systems, and that is where we're talking to tier 1s or OEMs in the space, and they're interested in using the technology either for torque measurement or temperature measurement in electric drive systems. And I think the rate of conversion of those into contracted business will accelerate as soon as we can start putting the evidence and data into people's hands that really help them build the business cases internally as to why this is something that they should be investing in. So very good progress to date, and real tangible market traction in terms of the work that we're on contract with, but a much bigger opportunity that we've got to deliver on there in the e-drives market. So the robotics space is one that we've talked about before. So industrial machinery and robotics, a bit like aerospace. Today, torque sensors are used in industrial robots, and particularly collaborative robots, which has been a big growth area. So you'll see, some really exciting kind of market growth figures for industrial and collaborative robots. I think this market report here was forecasting nearly 30% CAGR over the next few years, and it's become very, very common to deploy torque sensors into the joints of industrial robots. So we recognized this and saw that there was an opportunity to potentially improve those sensing systems using SAW technology. So in a kind of similar way to the aerospace market, we're not necessarily having to educate the market on the benefit of using a torque sensor from sort of ground zero principles, but we're just having to demonstrate why a SAW-based torque sensor is better than the conventional technology that they're using in that marketplace. We've been working to get some traction, and it's really good that we are able to say that we've got our first contracted piece of business with a global company who are a leader in the manufacture and development of robotic drive systems, and they're starting an evaluation on SAW torque running with them. We expect that to take months, so there'll be a lot of engineering activity with that customer before it sort of breaks through into a kind of production system deployment type project. But we're on the first rung of the ladder with a very, very credible customer in that space. We also have some other opportunities in the space. Again, another robotics manufacturer and another robot drive system manufacturer. So expecting to close some more business out there. There's obviously other opportunities alongside this. We group industrial, so things like agricultural machinery and stuff together with robotics in our pipeline. So you'll see in the pipeline data there is more opportunities and activity in the industrial space that we have. But I think it's very, very significant that we're now on contract as well in robotics, and that's a major milestone really for the business, having that market traction that we've got in aerospace and that building momentum there, the work that we've done and the progress that we've made in electric drive systems in the automotive space in particular, what's starting to crystallize there. And then now being able to say that we're on contract with a robotic systems manufacturer. It's really really good progress for the business. Okay.
Excellent. Thanks very much, Ryan. And Melvin, we'll pass over to you for the financials. Thank you.
Thank you, Nigel. I'm going to try and make this as exciting as the previous presentations. As you can see, there is a lot happening in the business. Nigel and Ryan have made a lot of references to some of the financials already, so I'm going to run through those quite quickly and talk more about the current trading and forecasting, which is an area quite involved in. So looking very quickly at the financial highlights, revenues are up 10%, PBT up nearly 2.5 times, benefiting from the reduction in overheads following last year's restructuring. Earnings per share up nearly 3/4. Cash is very strong at 1.3 million, rising to 1.9 million at the end of January after the Q2 royalties. Treasury shares are standing at 100,000 at the balance sheet date, and then they subsequently have risen to nearly 900,000 post-year end, which represents about 6.6% of our share capital and an average acquisition price of 82p. Distributable returns are at 2.8 million. Let me turn to the next page. Looking at segmental performances, revenues, iTrack up 26%. TransLogik marginally down at just under 500,000, but as Ryan said, this last year was a record year and we've done well to maintain it at that level. TRANSENSE is the largest fall, down 43%, but having heard both Nigel and Ryan's presentations, you'll see the numbers belie the true position, and my take on that a bit later. From a contribution perspective, iTrack contributed 1.2 million, TransLogik just under 200,000. TRANSENSE was a loss of just under 400,000, but a reduction of 21% on the previous year. Central overheads reduced by 5%. Looking at cash, we see a positive inflow of cash in the period of around 330,000, leading to a closing cash balance of 1.3 million, and that rises to 1.9 million at the end of January, as I previously stated. Also, bear in mind, we have outlaid 900,000 on share buyback. You will see we still have around 22 million of tax losses, which at a 25% corporate tax rate is worth 5.5 million as a deferred asset. Currently, we have taken a very prudent view and looked forward just 2 years to calculate our deferred tax assets. So in the balance sheet, it is so in effect, we have a hidden asset worth over 4 million that is not on our balance sheet. Looking at current trading and forecasting, in H2, both TRANSENSE costs and central overhead costs will rise, demonstrating our commitment to investment in the business and in anticipation of good growth in both TRANSENSE and TransLogik. The headcount has increased from 18, including a new starter in November 23, to 23, which also includes Kevin, who we've made reference to, is running TransLogik. We've also committed to increase CapEx to strengthen the facilities of the engineering team and improve the supply chain. We are currently carrying out a refurb of our premises, having committed to a further 5 to 10 years. The offices will look far more modern and professional, which is increasingly important as customers are choosing to visit us. And when you look at the quality of our customer base, the image we portray becomes particularly important. Budgeting and forecasting. Now, there's one that I really enjoy. Whilst TRANSENSE has been around for 25 years, the reality is the new TRANSENSE was born in June 2020, as I've said before. So that makes us effectively a 3-year-old startup, and forecasting revenues in a startup is always a challenge. Looking at the 3 segments, Bridgestone iTrack, we are fortunate as we do have guidance from Bridgestone's own budget, although in the first 3 years, a couple of those years were over-optimistic, and despite a degree of prudence that I build into my figures, that segment has slightly underperformed. Going forward, they have toned down their expectations and the numbers should be far more predictable, giving us better clarity. TRANSENSE income has doubled in the 3 years, but pipeline visibility beyond a few months is not readily available. So a challenge to forecast, but underpinned by the growth in that business. We are confident we will have better understanding of future performance following Kevin's appointment as the translogik sales director in January. TRANSENSE, whilst we are getting far better visibility as the pipeline of opportunities has grown substantially, as Ryan demonstrated, contracted work is still in single figures and at an early stage. So this issue is one of timing, and this will improve over time as we build up more and more momentum. Looking at the full year's budget for FY24, the numbers were very much weighted in favour of H2, and the bottom line for H1 was actually fairly much in line with our expectations. The outlook for H2 and the full year are set out in Ian German's latest research note, and they indicate a modest reduction in profit before tax for both FY24 and FY25. Having achieved or exceeded market numbers in the 3 years post the Bridgestone deal, maybe a degree of over-optimism creeped into our numbers, although for the main part, the reduction is due to slippage beyond our control and challenging global economic conditions, which have impacted many companies, particularly in our sector. Incidentally, the revised market numbers would still represent a 50% PBT growth year on year, which in the current economic climate should not be understated. One final point to leave you with. Most of my career, despite 15 years at TRANSENSE, was spent as a chartered accountant in practice and advising numerous successful independent SMEs. One important lesson I learned was that once the SME had achieved sustainable positive cash flow and profitability, their principal focus going forward would be generating a strong and growing pipeline of both orders and genuine opportunities. Additionally, it was essential to build and retain a talented leadership team, develop a strong and committed workforce, and an innovative and experienced marketing team. What I have just described is, of course, where TRANSENSE are right now. Although as a public company, there is always going to be a focus or pressure on the P&L and balance sheet at 2 points in each trading year. However, it's essential to look beyond that when assessing our performance, and the feedback so far suggests investors are doing just that. And in answer to one of the questions I noticed as I was reading, which is Nicholas S., that's why I remain strongly optimistic, and it's a phrase you don't generally hear from chartered accountants. So that's my take on the forward. Back to you, Mike.
Well, thank you, Melvyn, and I think that was a really good summing up. Those listeners who know Melvyn well and have listened to him before will know that when Melvyn is bullish, then things are really strong, because he's the archetypal pessimist on the board who has kept us through some very difficult times in the past, but is now very positive about the future. And I think that really shares very much the mood in the boardroom. There are a lot of exciting things going on, some on the surface, which you've heard about today, some beneath the surface. But I think that leaves us all very highly motivated. We're all enjoying life. We're all working very hard, but we're all completely committed to the bright future that we believe that the company has. I'm now going to pause. It's 16:43. We've got about 15 minutes to take questions. Perhaps I could ask if you could put them into a logical order and fire them at us, please, Tom, and I'll...
Yes. Yeah, thank you. Thank you, Nigel, Melvyn, Ryan. We have had a number of questions ahead of the event and quite a few during the event as well. So maybe, Nigel, we can start with some of the pre-submitted questions and maybe some of the ones which have come in on a live basis. You could tie some of those in when you see the opportunity. Additionally, your feedback is important to the company. So immediately after the presentation has ended, you will be redirected for the opportunity to provide your feedback. Nigel, if we could start with this one, maybe. What is the future likely value of iTrack royalty income, and when does it come to an end?
Right. The royalty agreement was signed in 2020 for a 10-year period, so it comes to an end in 2030. And in big picture terms, up to the end of this period upon which we're reporting, we've collected £5.6 million worth of royalty income. And if there were no additional installations from the end of the period that we've just reported until the end of the royalty period in 2030, so if the number of installations remained static, then there would be approximately £10 million or so of future revenue. if it continues to grow at a compound annual growth rate of 15% in terms of volume, then despite the 2 step reductions in the unit royalty rate, that would come to 16 million of further cash to collect between January 24 and the end. So broadly speaking, even if you take a reasonably conservative view and take the midpoint of those 2 numbers, then the future cash flow underpins the vast majority of the company's market capitalization today, and suggests for investors, a very low cost current entry into the opportunities that TransLogic and SOAR offer.
Super, thank you. A couple of questions around TransLogic. I'm just going to group a couple together because they work quite well. Please will you flesh out the specific routes to market being pursued for the TransLogic product range? And Henry asked a couple in the live Q&A, which was, what is the driver for the rebranding and rationalization in the TransLogic model range? And what proportion of the tyre service market do the top 4 producers account for? I don't know whether those all work together.
No, but dealing roughly in reverse order. So if you look at the global tyre market, there's some very big players, and basically the top 5, top 6 players are Michelin, who are notable in that they are the one we don't deal with at the moment. Bridgestone, Goodyear, Continental, Sumitomo, which is a big Japanese company that have a number of different brands, and then Pirelli. So there's a few others in the top 10, but basically, Michelin and Bridgestone are they trade places for the top spot, and they each have something like 15 to 20% of the tire market. You're looking at north of 20 billion of sales for each of those companies, so they are very, very big. There's a bit of a jump down. Goodyear and Conti are sort of 12 to 15 billion in sales in their tire businesses. Obviously, Conti is a much bigger business outside of tires, with its automotive tier 1 activities. So that hopefully gives you a sense. These are big companies. Overall the top 10, I was trying to kind of tot it up because I don't have percentage figures, but it's something like 100 billion in sales. So they have a significant chunk of the tire market.
Ryan, if I could just redirect that question slightly, because I think this is a relevant piece of information. In terms of tire service provision, then if we're dealing direct through the major players, we're really talking about managed tire contracts for people who are buying their tires exclusively. Whereas entering the fleet market directly, we're able to get to people who are not working under my managed tire contracts. Have you a view on how much of the market we haven't touched yet relative to how much is handled by the global majors from a tire service point of view?
Yeah. So that's a really important point. So what people listening might not realize is that the big tire companies for commercial vehicle tires, they have 2 models. Basically, they sell tires. So just as you and I would buy tires for our vehicles, truck fleet operators can buy tires, but they also do these pay per mile or pay per kilometer deals where effectively they're leasing tires. And that managed tire business is where our tools are mainly used today by the big tire suppliers. So that the technicians that work for Bridgestone or Conti use our tools as part of that managed contract tire business. What we've learned in the last year is actually that is, depending on the country that you're in, it really impacts how big of a market that actually is. But it's certainly not anywhere near half of the commercial vehicle tire market. And we've heard numbers as low as 10% and as high as half of the market, but reality is it's probably somewhere in between. So there's a huge portion of the market that isn't covered by these managed tire contracts that the tire suppliers would typically offer, and that's where the fleet would either manage its own tires or an independent tire management company would manage the tires for the fleet for them, and that in itself is quite a big market, and there's some key players on that side. So we looking at the market in a few different ways. So the primary focus is the commercial vehicle space. I know I mentioned hire car fleets, but really we're looking at commercial vehicles. We're looking at truck operations and bus operations for commercial vehicles. So managed tire contract operators, like the big tire companies, is a big chunk of that, and that is a key route to market for us. So building the business with the existing companies, and finding some more tire manufacturers to work with in their businesses. That's going to be big activity for us moving forwards. The other is the tire dealers, the sort of non-OEM companies who are supporting commercial vehicle fleet operators. So that's tire dealerships. It is a thing today where tire dealers will actually carry out on a kind of contract basis tire inspections for commercial vehicle fleet operators. So the tire dealer market is a big market, and we can approach that market directly, and we've done that, and we're having some success there, and indirectly working with the companies who are supplying the specialist software systems that those businesses run on. And we've had quite a lot of success there, actually recently, building relationships or reseller relationships with those software system providers. So that's another key channel into the market for us. And then finally is actually working directly with those fleet operators. So building relationships with commercial vehicle fleet operators, generating some market pull with them, and really awareness of what they could be benefiting from with a product like the TransLogic product going into their market. So that's the routes to market. Do we want? The rationalization. So that's quite a simple question to answer, really. Today we offer 4 different versions of the product. Really, most of the sales are around 2 different versions of the product. So from our perspective, to make inventory management and try and sort of leverage some scale opportunities in manufacturing costs and such like, we're trying to rationalize those numbers, but really focusing around what the market actually is buying from us moving forward. So we're trying to make it a bit easier for customers to understand what the products do, and which one is the best for them for their operation.
Great, thanks, Ryan. I'm just mindful of the time, Ryan. We've got about 8 minutes left, and I want to take certainly 2 more questions at least. There were some questions around the ITEP and FARA programs. Indeed, there's 2 or 3 sort of associated questions. You might just read the main question out, please.
Yeah, Tom? Indeed. So what will the effect be on TRANSENSE from the US Army's recent announcement that they will be keeping ITEP in development rather than moving it into production?
And following on from that, somebody else has referred to the FARA program being the announcement that it's going to be cancelled.
Indeed. So the second question was, what impact will the cancellation of FARA be on the company?
Great. If you could take that one in about 4 minutes, Ryan, that would be great. Thanks. I'm sure you could take it in 4 hours as well.
Yeah, no, it's a really short version, because obviously we have an awful lot of contact with all the key players, and increasingly so. But it is clear, and it's public knowledge, the US government has announced that it's discontinuing the FARA program. But actually, both of the manufacturers that were developing aircraft for FARA have come out and said they are continuing with their development, because the US government, wasn't their only customer. So yes, FARA is cancelled by the US government, but the actual helicopter manufacturers are continuing with their developments, because they have other customers for those aircraft. FARA was not the prime application for the 901 engine. Really, our primary application, or the primary application for 901, is what they call a capability upgrade program. So the Black Hawk and Apache fleets are receiving these midlife upgrades over the next few years to increase the power and performance of those existing aircraft. And if you read the detail of the press around the FARA announcement, actually part of what they're saying is they're going to put more investment into capability upgrade programs. So that's interesting. But what we have been told and reassured is that actually it does not have an impact on those capability upgrade programs. There had been some delays to the 901 program that were announced last year by GE, And as far as we are aware and what we've been told is that it's in line with those capability upgrade programs. We're expecting production start in 27. So, FARA, we don't expect it to adversely impact the longer term revenue, and we still see there's positive opportunities for short term with GE on this and other programs.
Great, well done. Thanks, Ryan. Kept to time beautifully. Tom, there's 2 or 3 questions grouped together on buybacks, which I'd just like to take as well, if I may, please.
Indeed, yeah. Do you want to pick those up?
Yeah, thanks. So, first of all, a question from, there's a couple of questions from Nicholas S. actually. Isn't it wiser to spend money investing in new salespeople rather than buying back stock? And the simple answer to that, Nicholas, is we don't see them as being mutually exclusive. I think that's really what the body of this presentation has been around. We do not feel constrained by cash. We're not constrained by the size of our distributable reserves now from being able to fund buyback programs, and there is always first priority towards investing in the business. And when there are sensible opportunities to invest within the business to accelerate growth, then we'll do it. And that's precisely why we're putting more resource in now. But there is a sensible rate to inject that resource. There's no point adding cost to try and go 100 steps ahead if there's only 3 or 4 steps visible. So we've always believed in building the infrastructure of the business to be 1 or 2 steps ahead of the opportunities rather than 8 or 10 steps ahead. But yet we've been able to generate more than enough cash to be able to fund buybacks. Also picking up on other questions, we have not by any means ruled out dividends in the future as being another means of returning cash to shareholders rather than buybacks. We'll continue to keep both of those routes under review and choose the most appropriate one. I think also another relevant question, why has there been so little director buying of late? I have to say, Nicholas, I think that's a bit below the belt, that one, because I don't know many AIM companies where the executive directors have consistently bought shares as frequently as we have in the market. So I'm going to take slight offence at that, if you don't mind. But I've personally built a portfolio of 265,000 shares in this company. They've all been bought in the marketplace. I'm very happy with my investment. When the share price weakness, I've taken the opportunity to add. But I've been on the board now for 7.5 years. 3 of the last 3 have been especially exciting. But out of that, there's probably at least 4 or 5 years in total when I've had some inside information or other that's prevented me from buying shares. Frustratingly, often when the share price has been at its weakest in the past, although it's now very stable. But I remember one period when it was down as low as 40p and I was dying to buy some and couldn't. So, be mindful that the directors aren't always allowed to buy when they might like to. That's partly true of the buyback program as well, but to a lesser extent, because the company does actually place a standing order to execute the buyback program at a time when the company is not possessing inside information, which can continue despite then coming into inside information. So there are times when the buyback program can be executed even though the directors can't buy. Mindful of the time, we've got 2 minutes left, and the question which Melvin's already answered, but which I'm dying to answer too, has there ever been a time when you have been more bullish? I hope that our enthusiasm and our excitement comes across, because we really do genuinely believe that the company has some very tangible opportunities to grab a hold of here. And yes, we do feel very positive about the future. Having said that, it's a very uncertain and difficult world out there, as we all know, and there's lots to be scared of. It doesn't scare me as a director of TRANSENSE half as much as it does as a human being. But, things are tough out there too. But with all of that in mind, we still see lots of opportunities for this company and think it's a great investment.
Super. All right. Well, look, thank you, Nigel, Melvin, Ryan. There are remaining questions which we will address. So for those who haven't had their questions answered, please don't believe we're overlooking them. We've just run out of time, and therefore we'll answer those online and publish those on the Investor Meet Company dashboard. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on TRANSENSE, please do get in touch via transense@walbrookpr.com. In the meantime, many thanks for attending today's presentation.
Thank you very much, everybody.
Thank you.